Hey guys, Ben Killer here, aka Spy Hates Me from Twitter. What I'm going to do real quick is I'm going to give you guys a quick explanation of what LEAPS are and a basic strategy on investing in LEAPS. If you are a swing trader or a long-term trader and you want to introduce yourself into options, LEAPS are by far the best way to do it with minimizing your risk rather than jumping into quarterlies, weeklies, front months, so on. So what a LEAP is, it's a long-term equity anticipation security, which is just a fancy way of saying long-term contract. What I mean by long-term is anywhere from 9 months away expiration all the way to 3 years. And so the reason that these are so popular and the reason that I like them the most is they amplify your gains relative to the stock price movement. And they're a very good way to get exposure to stock and leverage returns with limited risk. So if your $100 stock price moves up 10% and you have one share, you get $10. If your $100 stock price moves up 10% and you have a LEAP, that price is going to move up a lot more than 10%. Your profit will. And so what we're going to be looking at is one of the most traded LEAPs, which is a lot of the ETFs, but SPY specifically, the S&P 500. I'm going to just be comparing the differences between the front month and a front month. If you don't know, a front month is the nearest term expiration, the monthly expiration, not weeklies or quarterlies. So first thing I'm going to point out is the bid and the ask on the front month. You see how close they are at 325 and 323? Very close. That's a 2-cent difference. So that's $323 you're going to be selling at a bid, or $325 you're going to be buying at an ask. Whereas we're going to go to the furthest away, which is going to be December of 2023. You can see and that's the furthest, 943 days away. You can see the bid and the ask, how it varies. $46.50 and $48. So you're paying $4,800, or you're selling for $4,650. That's $150 difference. So what I'm going to tell you, the first thing you're doing if you're investing in a LEAP and you're trying to get it filled, don't pay that ask. That's already going to be $150 negative out the gate. A good one to get filled at is the mark, which is the mid price, which is going to be $47.25. If you can get below that, that's fine. Remember, this is a long-term investment. This is not something you have to rush into. Try to get yourself the best price possible without making yourself upside down right at the beginning. Next thing you're going to want to look at is you're going to want to check the open interest and the volume. So as you can see on SPY, which is very popular, the open interest, the volume is it's pretty high, and that's the front month. And even on December 2023, I mean, it has decent numbers. So when you're looking at something like this, you're not going to have to worry about the volume and the open interest because it's the S&P 500. You're not going to have any issues with it. When you're checking out something like this, when you're checking out something like this, so the furthest one away has 3 open interests. If you didn't know, an open interest is the amount of contracts that are available and that are open and unsettled still in the market. So it says 3 and nothing on the put side, 3 on the call side. So this is something that I would not invest in solely because there's nothing going on here. So that just gives you a red flag right there. But things like CCIV, people are very bullish on this. This is not something you have to worry about getting filled. Look at the open interest. Look at the open interest and look at the volume. They're relatively high. That's something you're not going to have to worry about. So I'm going to head back over to SPY, and I'm going to show you a couple more differences. So what you're going to want to look at as well, or you're going to notice as well, is the delta. So the price movement. So the delta is every time the price goes up $1, this is how much you get. So if the stock moves up to 417.58, you're going to get $52 on the month, sorry, the front month. And the same thing down here, it's going to be relatively the same depending on which spread what contract you pick, but it's going to be relatively the same for an ETF LEAP. So you're going to get about $53 if you got that at the money, which is good. You have 943 days to accumulate $53 for every dollar. That's why you're going to notice a big price difference between a front month and a leap. I mean, you're going to notice a couple $1,000 a lot of times because you have so many days to make profit, and there's a very big chance that you're going to make profit on something like this. Other stocks I cannot speak for. But so this is going to cost you $47.50 if you got the mid, whereas the front month is only going to cost you $325 at the ask, $323 at the bid. One more I'm going to point out is theta. So this is what makes contracts that end soon so risky. Your theta is at 26. So every time, so say we moved on to the next day and there was no price movement at 416.58, you lose $26 of your $325 with no price movement. Whereas if the same circumstances applied and there was no price movement and you had a December 2023 leap, you would lose $2 from no price movement on a $47.50 investment, which is what makes these so not risk-free, but a lot less risky. And so one thing I'm going to tell you is, or one thing I want to point out is showing you the difference between investing in shares and investing in a leap. So investing in shares, say you had a $3,000 budget, you wanted to buy 10 shares a year ago, you bought them for $291. We say you bought it low, you're the best trader ever. You bought them at $291, so you spent your $3,000 budget on 10 shares and you sold that $3,000 budget for $422 a piece. So you spent $3,000 and you got about $42.50 back. And so, I mean, that's good. That's about a 43%. Yeah, about 43% increase over a year's time span, which isn't bad. But at the same time, you could, if you bought, if 1 year ago you bought a June leap for at the money, which would have been around let's say around 290. Say you bought a 295 at the money call 1 year ago. So you bought that 295 at the money call 1 year ago, and that cost you 27.3. You're the best trader ever. You bought the low at 27.3, right? And then you sold it at 127. So you spent your $3,000 budget right here at $2,700. And that $3,000 budget over the course of 1 year turned into $12,700 for about a 340 something percent increase. But one thing I'm going to tell you is if you bought that 1 year contract, you're not going to hold it. Please, you don't hold it for the year. And I'm going to explain to you right real quick. So if you bought that 1 year contract and something, let's go back to a 2-year chart, and everybody remembers what happened right here. So you bought that 1 year contract right here for, say you bought a 1 year contract for $20, right? So that was $523. You bought that in $523 and you held it to the expiration. You're only going to make like $200 if you held it to expiration. So I'm going to give you my basic strategy and a very popular strategy, which is rolling leaps. Rolling leaps is buying contracts with the intention to hold them for 1 year, but you do not buy the 1 year, you buy the 2-year contract. So what I mean by that is if you bought this contract 2 years ago with the intentions of holding it for 1 year and something like this happens, you bought it for that $20 a contract, and then this happens, and then that year's up right here, you have a whole extra year to recover. It gives you wiggle room, buffer space, whatever you want to call it, to maximize that profit. So rather than it expiring where you're barely scraping by on any profit at all, you could have held it for 1 more month past that year mark, because you have a whole other year buffer, and sold it for 100% profit right there. Wait a minute, buy another 2-year contract. And a year from then would be now. So you buy that another 2-year contract and sold it for another 300-400% profit almost. So that's what it is. It's called rolling leaps. So you buy that 2-year contract with the intentions of holding it for 1 year. But with the intentions of holding it for 1 year, you have an extra year of wiggle room to where if that 1 year doesn't work out, it gives you more time. That way you're not stuck for time. That way you're not sitting in this spot right here with 4 days to expiration and you're barely at profit. With 4 days to expiration after holding something for a whole year, you're barely at any profit. So you just wasted a whole year of your time, $3,000 of your money tied up for $200 profit. So that's what I recommend is rolling leaps. What I do want to say is if you do buy 1 year, do the same thing with the intentions of cashing out 6 months later, but having the extra 6 months as buffer space, because you don't want to get caught at the expiration date and something like this happens, or something like this happens, and you bought right here, and say this is when your contract expires, you could end up selling it for less than what you bought it for because you have no choice because it expired there. So to minimize your risk, plan to get rid of it at least 6 months in. Before that, if you're at good profits, go ahead, scale out. If you bought multiple contracts, scale out, take your profits, let the other ones ride. And one thing I do want to mention is I didn't say anything about implied volatility, and that's because when it comes to leaps, the implied volatility is stable for long term. Usually a drop in implied volatility means the stock is rising. So if it is going up, it's going to balance out. So implied volatility, when it comes, relatively speaking, when it comes to leaps, is not something you have to worry about. But that is pretty much all I have on leaps. If you guys have any questions, shoot me a follow on Twitter at SpyHatesMe. Send me a DM up here. Doesn't matter. I'll get back to you regardless. I do a lot of option trading. I try to educate people. I'm going to get more into that lately. If you have any requests, let me know. I can definitely look into it. Other than that, guys, have a great day. Good luck this week.